Hello everyone, today I'm going to talk about why Palantir's Q3 earnings report was so good. I'll list the reasons and then I'll go through them one by one. Earnings and revenue beat, 4 quarters of GAAP profitability, rising revenue across the spectrum, strong commercial performance relative to government, rising adjusted operating margins, continued high free cash flow margin, significant earnings guidance upgrade, declining stock-based compensation in conjunction with stock buybacks. And I'll finish this video with my thoughts on Palantir's current valuation and price action. So let's dive into the report. Palantir beat both its earnings and revenue guidance. Reported EPS was 7 cents versus 6 expected for a 25% surprise, and revenue was 558 million reported versus 555 expected for a marginal beat. This makes it Palantir's 4th consecutive quarter of GAAP profitability, which entitles it to join the prestigious S&P 500 index, probably in the 3rd week of December. We should see an announcement confirming it in the coming weeks. This makes Palantir more appealing to institutional investors and may spur buying in the meantime. On the revenue growth front, it's looking healthy with a 17% revenue growth rate year over year. Maintaining high revenue growth is crucial for growth stocks like Palantir. If this declines in the future, the market may react by giving it a lower price to sales multiple, which usually means a correction in the share price. If it can get back above 20% revenue growth in the next quarter, it would be ideal. Digging further into revenue, I want to talk about commercial revenue versus government revenue. Now, Palantir started off as a government-oriented provider, but has since expanded its product offering to commercial customers. Even though there are benefits to having a large government client base, it's arguably more profitable in the long run to target commercial clients because the revenue pool is much bigger. This is where Palantir's new AI platform, AIP, comes into play. It allows companies to integrate large language models into the existing Foundry platform for specific use cases. Here is a whole bunch of use cases along with logos of some very high profile commercial clients. So is AIP helping to grow commercial revenues? It appears so. Global commercial revenue grew 23% year over year from 204 million in Q3 2022 to 251 this quarter. This was nearly twice as much growth as government revenue growth, which was only 12% year over year. If we project the current growth rates to future years, commercial revenues will eclipse government revenues in just 2 years' time, which is around Q4 of 2025. I think the market likes this shift towards commercial revenues because it allows for a larger and more diversified customer base. It also allows Palantir to be less reliant on one giant customer like the US government for the bulk of its business. Let's now shift focus to adjusted operating margins. Operating margin is a profitability metric that is calculated by dividing operating income with revenue. The higher the number, the better it is for profitability. Adjusted means stock-based compensation has been removed from the calculation. This prevents stock-based compensation from obscuring underlying performance. As we see in this chart, adjusted operating margins have consistently risen over the past 4 quarters, with the current one showing the highest margin at 29%. The market likes this metric because it means Palantir is now converting more of its revenue into income. Another important margin metric is adjusted free cash flow margin. This metric tells you how much revenue the company is turning into cold hard cash. As you can see, it's a bit more volatile, and last quarter it dipped a fair amount, but it made a nice recovery this quarter to 25%. This metric will be an interesting one to look at next quarter. If the company has good operating leverage, we should see an increase in the free cash flow margin as revenue expands. Let's now look at Palantir's guidance for Q4. Its revenue guidance increased only marginally, but its earnings guidance hike was more significant at around 5%. The market liked this guidance hike, particularly since earnings is more important than revenue. With the AI sector still heating up, there is a real possibility that we may see another guidance hike in the next month or two. If that happens, prepare for some serious upside. Let's wrap up with a discussion on stock-based compensation, or SBC. Now, this has been criticized by some investors because it dilutes their holdings. Fortunately, SBC has been declining continuously and should be less than $100 million a quarter by next year. This, combined with the $1 billion buyback announced back in August, will reduce the shares on issue, which is good for shareholders as it increases the value of each share. Finally, I want to give you my take on Palantir's current valuation. By any traditional metric, Palantir is grossly overvalued. However, it doesn't mean it can't get more overvalued. I just want to remind you that investing is not about buying undervalued stocks. It's about buying stocks that go up in price. There is nothing about valuation in that last statement. Valuation can be a tool to help you identify entry and exit points, but that's all it is, a tool. Valuation tries to boil down investing into a science, but it's much more than that. Investing is both an art and a science, and all I'm going to say about Palantir is that the price action suggests there is more demand for the stock than supply, which is bullish in the short to medium term. This is pretty evident when you look at the weekly price chart over the past 12 months. We see a clear bottom and some heavy buying as the price more than tripled from its bottom. The key thing to note here is that Palantir has managed to hold onto most of its gains, which is extremely bullish going forward. Anyway, I'm going to leave it there, and until next time, happy investing.